Coming to you live from the palatial studios of PBJ Productions. Welcome to Patrick and BJ Talk Real Estate, where we talk about life, the universe, and everything as it relates to real estate. Hey everybody, it's BJ.
And Patrick.
And we're back talking all things real estate. And today we have a special guest with us, David from Olympic Mortgages. So David, thank you for joining us today. We appreciate it.
Thanks for having me.
And we are going to talk today about some of the latest, greatest that we're hearing about interest rates and what they're talking about with the potentially in the new budget and all of these things that are coming out and how it affects the whole industry really as far as homes and home buying and so forth. And I know, we're looking at some of the different headlines and there's talk about this market is getting, not just this market, the housing market is getting ready to take off as soon as there's some clarity in what's happening with interest rates from the Bank of Canada.
Like we've said before, we're sort of at the red light, it seems.
Yeah.
Revving the engines, ready to go.
Right.
Yeah.
And we may hit some policy things that the government is talking about because we all know the government's going to save us from everything.
Of course.
Right.
And we have federal elections will be happening next year. In BC, we have BC elections happening by the end of the year.
Right. So
that by the fall. So there's a lot of
that means there's going to be a lot
out.
of candy dangled before us for our votes. Is that what you're saying?
Oh, it's not like the carrot and the stick. It's candy now.
Well, whatever.
Okay.
It's you get a quicker fix from the candy, and then it's gone, and you're just left with the with the insulin rush after while you're exhausted.
Yeah, just left with candy wrappers.
Right.
Gotcha.
So
okay.
So where should we start?
Well, we got David here. He can give us some expectations, forecasts on what's happening with interest rate, mortgage demand, those kind of things.
So yesterday, as you guys know, the Bank of Canada held the overnight rate steady. The Bank of Canada did not lower the rate like a lot of people may have been wanting or anticipating.
Right.
They didn't obviously raise the rate either. The interest rate, the overnight rate is now at a point where it's restrictive enough on our economy and on borrowing that there's no need to raise the rate anymore. Most people are now expecting the rates to start coming down. And that is really going to depend on still economic factors that haven't happened yet. Mm-hmm. So I keep telling my clientele, it's like, well, we could be waiting longer for interest rates to come down, or it could happen at the next rate announcement. It all just depends on what our economy reports with regards to inflation. Right. If inflation has picked up again, or if the government sees any kind of serious retraction. So if we see inflation maintain or rise up a little bit, I would say we're not going to expect any rate cuts anytime soon. But if we see other factors, if we see a recession, then we'll have the rate start to come down. Right. If we see unemployment numbers increasing by a significant factor, that'll affect interest rates.
Right. We just recently saw the national unemployment rate go up by like 1%.
Yeah, it's not a significant enough drop to indicate that we're in any kind of serious contraction.
Yeah.
But that's sort of that's an indication that the restrictive rates where they're at now is working.
Yeah, and I know we talked about this not with this current rate adjustment, but the previous one, where the Bank of Canada came out and said we don't want to undo everything that we've done by lowering rates prematurely.
Right.
Because their indication at that point was they recognized where the housing market was at.
Right.
And their idea was, and it carries forward now, is that once we drop these rates, even a small amount, it's going to just act as greater impetus for the real estate market to really start taking off.
Right. So
in the meantime, like clients, mortgagers are weathering the storm.
They are, yeah.
No, it doesn't seem like from your clientele.
From my clientele, I don't think I've had any clientele that have, for example, not being able to make their mortgage payments. We've checked in with everybody. Everybody's being able to make their mortgage payments. Everybody's been okay. and most of my clientele are kind of just holding on and waiting for the rates to come down.
And let me just ask, are they waiting to get in the market, those people, or are they already in the market and looking to sell and buy something else, or what is that situation?
So clients of mine who are just in the market already and have a variable rate mortgage.
Okay.
So those are the people that are paying more in interest since they got their mortgage originally, maybe 2 or 3 years ago, because the rate has come up quite a bit. And now those folks especially are just waiting now for fixed rates to come down. So when we're talking about rates, we're talking about two separate things. We're talking about variable rates, which are affected by the Bank of Canada rate announcements, and then the fixed rates, which aren't. And they're more of an indication of what bond yields are doing and what savings rates are doing.
Right, because right now they're lower than the variable rate.
They are,
kind of trended downwards.
They have, yeah. So on the fixed rates, I'd say we had a peak in summer 2023. So right around summer, August, September 2023 is when we really saw a peak in the fixed rates.
Right.
Yeah.
Now we're back in the summer, we were at maybe 6% on a 3, 4, 5 year term. Now we're back down to around 5% on a 5 year term and maybe 5.5% on a 3 year term.
Okay.
I don't think it's unreasonable for the fixed rates to bottom out at around 3.5 to 4. So we're not going to see the rates come down to previous lows where we were seeing fixed rates at 1.5 or 2%. We won't see that again.
Is that the 3.5 to 4? Is that an optimistic outlook on it, or is it sort of like a conservative view?
I would say it's probably neither, because it's too hard for us to, it's still sort of too hard for us to determine. That's more of me just saying, that's me being conservative in that I know that rates are not going to go down to previous lows.
I think everybody gets that. I think we were going through a sort of the high time of interest rates being super low.
Right.
Yeah.
It's that 3.5 to 4 mark is sort of a halfway point or sort of a midway point between the previous low and the high that we saw. Yeah. So, whether I'm being conservative or not, I think that's where it's going to be.
Okay.
Yeah.
Okay. So who does that really affect? Patrick and I have talked about this too, that a rate cut of, let's say, 10 points.
10 bips?
Yeah.
Okay.
So let's say we're talking about the average first-time home buyer. I can see that affecting them.
Sure.
But if there's somebody that's already in the market and they're thinking about selling and buying another home, less of an effect on somebody in that situation, would you say?
The effect that when the rates, the fixed rates are affected, so whoever's in the market right now has to stress test. The lowest stress test that we can use is maybe our 5-year rate, which is hovering around 5% plus 2. So they have to qualify at 7% still. When the rates drop, when and if the rates drop to 3.5 to 4%, that stress test is going to be either 5.5 to 6%. So those people will qualify for more money at that time.
Right.
But that doesn't affect people who are buying right now.
Sure.
So if there are people who are actively looking and going to be contracting on a property in the next 2 months, our conversation won't affect them really.
Okay.
Because they will still have to stress test at the current rate as it is now. I am now recommending to a lot of my clientele to probably take the variable rate as it is, because even though the variable rate is higher than a fixed rate, I do believe those people, if they can hold on to their variable rate for another year to a year and a half, they will then get the opportunity to lock in with their existing lender at 3.5 to 4, and thereby lower their total cost over the life the next 5 to 7 years.
Right.
What's the saying? Is it marry the house, date the rate?
Date the rate, marry the property. Exactly. And so that's sort of what I tell a lot of my clientele is people aren't going to necessarily remember whether their first mortgage was at 5.1 or 5.35.
I can't remember. Yeah.
But they're going to remember if they bought their house for 400,000
Yeah.
versus 900,000,
Yeah.
or 900,000 versus 1.3 million,
Okay.
right? So I do believe still that a greater emphasis should still be put on the property that a client is buying and the value that that property offers.
Sure.
That's a very good perspective. All right. Global News broke a story about a couple weeks ago on the banking regulator announcement. Not announcement. They didn't announce it, but Global News broke the story that the banking regulator wants to cap loans at 4.5 times the income.
Okay, so
What's your take on that?
this is I can see where a lot of folks might get confused about this piece of news that came out.
Yeah.
Because this isn't affecting individual borrowers. This announcement is actually affecting the bank or the lending institution as a whole.
Okay.
So basically, the government is mandating each lending institution to keep their total portfolio of mortgages around that calculation, 4.5 times the income.
Because they want the banks to be liquid.
They
It's
want the
essentially what
bank.
it
They
is.
want the banks to be safe with their lending, but
Yeah.
as a whole portfolio. So it's not going to affect individual lenders or individual It's not going to affect individual borrowers, except banks might be a little bit more. They might be a little bit more tight when it comes to giving approvals to people that don't qualify, because the more people that they give those loans to, the worse that number gets for them for their total reporting back to OSFI.
Right. So that might happen quarterly, it sounds like.
I don't
If
even
there's
know.
an assessment. But
Yeah.
Maybe, right? That's what I read.
Yeah, it's this piece of news is really just more directed at lending institutions versus individual borrowers.
Okay. Super.
But we will probably see underwriters and lenders getting a little bit tighter in their general sort of underwriting practices.
And that might not happen until the beginning of next year.
It's already happening.
It's already happening.
Yeah,
Despite their sort of news.
I mean, we see
So
as
in policy, that's already happening.
it maybe not even in policy as much as the banks are just being a lot more picky on who they're giving income or debt servicing exceptions to.
Practice, yeah.
And this isn't anything that's published. This is just the sentiment we see as we're submitting applications. Okay, maybe something 5 months ago that would have been an easy approval might be a little bit of a harder approval now, because we're seeing that the underwriting policies are getting a little bit tighter,
Right.
a little bit stricter.
I'm sure interest rates have something to do with that as well.
Well,
Just a risk assessment, really.
I think overall, in an overall perspective, our lending institutions have always been very risk averse,
Yeah.
yeah.
and
We're talking about AAA lenders, basically.
AAA lenders. Yeah. So I don't necessarily think it's just about the interest rates, but it's rather about these lending institutions, banks, and OSFI, the regulator, wanting to keep a real tight lid on making sure that that we're not going to have a whole bunch of people defaulting because they shouldn't have gotten their loan.
I'm really glad you clarified that, because I wasn't quite sure exactly what that meant. Like, I'm not on the mortgage side, I'm not on the financing side, I help you buy a house, all those kind of good things.
Yeah.
But that helps me understand that I can help, or I can explain that to other people better now too.
Right.
That's awesome.
Yeah.
Right.
Yeah.
Well, I think I want to add to that too, is if you have specific questions that you would direct towards David, just put it in the comments, and we'll bring David back another time and we can talk about whatever questions you have as well. Also, if you'd like to reach out to David directly, we'll put his contact information in the description as well. And he can help you with answering any questions that you have. Otherwise, I think that's it for this episode. We're going to be back with David here in a little bit because we have some more stuff to go over. But otherwise, if you haven't, please take a minute and subscribe to the channel. Just helps us out with getting the word out and growing the channel. If there's content that you think that you'd like to know about, because some of this we come up with because we're looking at what the reporting is saying and different things like that. If you have questions for us, certainly put that in the comments because we're happy to address those as well.
Awesome, David. Thank you for
Hey,
joining us.
thanks for having me, guys.
Thanks, Dave.
Always a
Thank
pleasure.
you for tuning in. We'll catch you in the next episode.
See ya.